Welcome to episode 21 of the SaaS Report. I'm your host, Matt Aird, founder at Sales Science. Today, we're going to be taking a look at Figma's S1. Yes, Figma has filed their S1 with the SEC, which signals their intent to go public. And so for the first time, we get a look at some of the numbers behind the company, right? So we've got income statement from them for about the last 9 quarters. So we're going to dig into those numbers today. We're also going to take a look at Adobe's Q2 results. So they announced Q2 results just last week. And then we're going to take a look at another section of the Q1 State of SaaS report that we released last week. And that's taking a closer look at how the performance of SaaS companies in different categories compares. So we're going to be breaking down performance by companies that operate in the data space versus the security space versus kind of general business apps, so that we can get a feel for performance across those different cohorts. So lots to cover, so let's get into it. So we got Q2 numbers from Adobe last week. They aren't in the kind of 35 odd SaaS companies that we track, or at least they weren't in the Q1 report. I'm going to add them into the report for Q2. And Q2 numbers, pretty impressive. So Adobe's at 22.5 billion in ARR right now. That ARR grew 11% year over year. So they added about $2.3 billion in net new ARR over the last 12 months. 632 million of that came in Q2. So pretty good growth for them, considering the run rate that they're at, right? Growing 11% when you're north of 20 billion in ARR is really impressive. They've got exceptional gross margins, so this really jumped out at me, right? Gross margin for the quarter came in at just under 93%, which is insane. The median for the companies that we tracked in Q1 was just 78%. I think there are only 2 companies that we looked at. I think it's maybe Asana and Monday that sit at about 90%. So Adobe really in a class of its own there in terms of gross margins. They spend about 18% of revenue on R&D, 28% on sales and marketing. So they had total sales and marketing spend for the quarter of 1.6 billion. CAC payback came in at 31 months for the quarter. So that's pretty good, right? Pretty good for a company, again, at a later stage. We typically see as these companies get more mature, right, more of that sales and marketing budget is probably spent on retention. Much harder to go out and generate kind of like net new ARR year after year. And so the fact that they're at 31 months there is pretty good. They've got a 37% free cash flow margin in Q2, 36% operating margins, which is outstanding. $708,000 in ARR per employee, so really efficient, and RPO of just under $20 billion at this point. So pretty good quarter, right, for Adobe. They're trading at a market cap of about 160 billion, which is about 7 times ARR right now. Not a difficult segue from Adobe into Figma. So if you remember a couple of quarters ago, there was talk of Adobe acquiring Figma. That fell through, but we'll talk about that more in just a little bit. So most of you watching this will be familiar with Figma, but for those of you that aren't, let me get you up to speed. So Figma is a design SaaS tool, right? So it competes with kind of Canva, I guess, on the lower end, Adobe probably on the higher end. And they've had a really interesting history as a private company. So they were founded by this guy called Dylan Field, who is still the CEO of the business. Dylan Field was a Teal Fellow. So basically the Teal Fellowship is an interesting program that Peter Thiel runs where he pays people to drop out of college, basically, and go and start a company. So Dylan Field was a Teal Fellow. He teamed up with a guy named Evan Wallace, and they started working on Figma in 2012. It took them until 2016 to get a product released to the general public. And then they subsequently raised 5 rounds of funding, total funding of $333 million over those 5 rounds. And then in September of 2022, there was this big announcement that Adobe was going to acquire Figma for $20 billion. That acquisition ultimately ended up falling through. This was during the time of kind of Lina Khan's reign, and this kind of period where it became very difficult to get acquisitions done on antitrust grounds, right? So acquisition falls through. Adobe ends up paying Figma $1 billion due to the fact that the acquisition got terminated. All right, so that catches us up and somewhat overlays with the data that Figma has just released as part of their S1 announcement. So when a private company files to go public or in the process of going public, they need to file what's called an S1 with the SEC. This basically tells the story of kind of the risks and the opportunities that exist within the business that they then share with investors. And so within that S1, we get a lot of information for the first time, publicly available information, around the track record of the business, their financial performance, and the underlying kind of metrics of the business. And so as a part of that, what we've got is 9 quarters worth of income statement from Figma, which allows us to calculate kind of a lot of the core metrics that we care about. And so the first one that we can take a look at is ARR, right? And the trend of ARR growth over the last 9 quarters. And if we look at this, we can see in Q1 of 23 that ARR was at just under $440 million. And over the last 9 quarters, they've got that up to about $912 million in annual recurring revenue. So more than doubled the business over the last couple of years. And if we look at net new ARR added quarter over quarter, we've got this interesting chart here where we see this real big pop in Q2 of 24 and Q3 of 24 as well. Now, there's a little blip here that shows up on most of these numbers for Figma in those 2 quarters. And the reason for that is that they got awarded that $1 billion by Adobe in the beginning of 2024. So that money was deployed pretty aggressively over the first half of 2024. And so we see some inflation here just in terms of sales and marketing spend, in terms of reduction of operating margins, and some accelerated growth off the back of that. Because they really took this pile of money and just threw it out into the market. They spent pretty aggressively for a couple of quarters there. Right, so if we take those 2 outliers out, we can see that they're pretty consistently adding somewhere between kind of 35 and 50 million in net new ARR per quarter. Right, so really solid growth. Right, we can also see this when we look at year over year ARR growth rates. And so we've got enough data here to look at this over the last 5 quarters. We can see that the lowest growth rate that they generated during that time was 43%. It got as high as 50% in Q3 and Q4 of 2024, right? And came in at 46% for Q1 of this year, right? So that most recent data that we've got shows them growing ARR up 46% year over year, which aligns to kind of the end of March 2025. Now, to put that in perspective, right, the median growth rate for the companies that we track, the 35 odd companies that we track in Q1 was 18%. So growing well north of that, right? They're growing faster than Palantir, growing faster than Klaviyo, growing faster than Monday, right? So really exceptional performance in this operating environment to be growing at 46%. Another thing that really jumped out at me, and this is similar to Adobe, which is interesting, is that they've got really strong gross margins, right? Gross margins have been sitting north of 90% over the last 5 quarters, except for that one dip that we've got in Q2 of 24. And again, that came as a result of this big spending push that they did once they got that money from Adobe. So truly best in class there, right? The only other companies that we track that have gross margin percentages north of 90% are Monday and Asana. So in that basket of companies, right, Figma would be the top of this list. And the median that we track is just 78%, right? So exceptional performance here. Now, let's take a look at operating income. And this one is a little bit all over the place. This is something that's going to have to become a little bit more predictable as they become a public company, right? Being private, you can kind of get away with this stuff because there isn't as much kind of scrutiny on operational consistency, but you're not going to be able to be a public company and have operating income margins swing this wildly quarter to quarter, right? So looking at this chart here, we can see that operating income was as high as 24% in Q4 of 24, and then got as low as negative 500% in Q2 of 24 when they were on that big spending spree. So pretty hard to get a read on what that operating income number is going to settle at. If we take the midpoint of the last 2 quarters, that puts them somewhere around 20% on operating income. I probably don't expect it to stay this high, right? That would be at the high end, especially for a company that's still pretty early in its growth, right? They're not yet at $1 billion in ARR. They're probably not going to try to generate 20% operating income. They've probably got grander ambitions around how to deploy that money into sales and marketing or into research and development. But it's a good sign that they were able to generate that over the last couple of quarters, right? The median for the companies that we tracked in Q1 was negative 2%. So they've got a lot of room there, even just to fall in line with 35 odd companies that we track. Right, now let's take a look at sales and marketing spend percentage. So again, this is a little bit all over the place and not a ton of consistency here around how much they're deploying quarter to quarter. We can see that it was as low as kind of 28% in Q4 of 24 and then got as high as 156% during their spending spree. But if we look for the last 2 quarters, again, this is kind of in the lead up to releasing these numbers, right? They were sitting somewhere around 30%. That's comparable with companies like Datadog, Pegasystems, and Appian. They're all sitting around the 30% mark, but is on the lower end, right? So the median for the companies that we track is at about 40%. Only 25% of the companies that we track have sales and marketing spend at 30% of revenue or lower. And so what we might see as these guys go public and they're looking to kind of grow, continue their growth rate, we may see that operating income slip from, 20% that we saw in the last couple of quarters. We may see their investment in sales and marketing push up more towards that, mid-30s to low 40s range as they're kind of trying to get more aggressive in terms of growing market share. Now let's take a look at R&D spend. We can see this is a little bit more consistent than sales and marketing spend. Obviously, we had the big push in Q2 of 24, but this looks like it's going to settle somewhere around the low 30s. That's slightly on the high side, right? The median for the companies that we track is at 26%, but much more in line with the market compared to their investments in sales and marketing. Right now, the one that I was most interested in was CAC payback, right? We've seen CAC paybacks blow out for almost all of the companies that we track. So how has Figma performed on this metric over the last 9 quarters? And the answer is pretty good. We've seen, right, over the last 8 quarters that we have data for here, there's only the one outlier quarter, which we can kind of discount here, where CAC payback exceeded 20 months, right? Now, if we take the incremental net new ARR that they've generated over the last 9 quarters and divide that by the sales and marketing spend, or essentially if we calculate CAC payback over the last 9 quarters, right, what we see is that CAC payback comes in at about 20 months, which again is exceptional, right? If we take the median of their last 8 quarters, that comes in at 14 months. Again, this is best in class, right? 14 months puts them in the same ballpark as the most efficient SaaS companies that we track, right? Palantir, Viva, Atlassian. So really strong go-to-market efficiency, which is a great sign for Figma, especially when you combine that with the fact that they're able to generate really strong growth rates as well at a pretty modest, right, sales and marketing spend percentage. We see a similar thing in terms of magic number. So when we look at this, quarter by quarter, we can see a couple of quarters there where they've exceeded $1 return in terms of net new ARR for $1 spent on sales and marketing. So Q4 of 23, that came in at $1.13. Q2 of 24, it came in at $1.52. We had another close one in Q4 of last year at 0.92 cents. So really strong performance there. If we were to map that performance against the SaaS companies that we track, they'd be in 7th place. So only AppLovin, Palantir, Pegasystems, Viva, Atlassian, and Datadog were more efficient at turning sales and marketing spend into net new ARR, right? So again, exceptional company for them on this metric. And then the final thing we look at here is Rule of X. So Bessemer Venture Partners tells us that Rule of X is the best predictor of valuation that we have for public companies, right? The higher your Rule of X, the higher your valuation in the public markets. And what we can see here is that Figma has an exceptional Rule of X. Now, we only have free cash flow information, which is one of the factors we need to calculate Rule of X. We only have free cash flow numbers for 2 of their quarters, right? That was Q1 of 2025 and Q1 of 2024. But when we look at those 2 quarters, the numbers are really good, right? Had Rule of X of 73 in Q1 of 24 and Rule of X of 133 in Q1 of 25. That number would put them in 4th place on our list. So only AppLovin, Viva, and Pegasystems have a higher Rule of X than Figma in Q1. So what is all of this put together mean that Figma is likely going to be worth in the public markets? So what I wanted to do was kind of try to find some public comparables and have a look at, what are those valuation multiples or what are those ARR multiples that those companies are able to achieve, right? And so if we think about Figma, what we've got is a product-led growth company that's growing really well, right? So high growth, PLG motion at around $1 billion in ARR. So Figma, by the time they go public, will probably be just north of $1 billion in ARR. And so when we look at some public comps for that brings up companies like Monday, Confluent, Rubrik, and GitLab. So we can take those 4 companies, and what I wanted to do was plot their numbers on a chart showing ARR growth rates and ARR multiples so that we can start to get a sense for how these companies are valued in the public market. So when we look at this chart, right, we can see that Rubrik is the only company growing faster than Figma. Rubrik grew at 54% in Q1. Figma came in at 46%, right? So they're growing faster than GitLab at 27, faster than Confluent at 26, and faster than Monday at 30. If we look at the ARR multiple numbers, we can see that Monday's at 14 times ARR, Confluent's at 8 times ARR, Rubrik gets a 17 times multiple, and GitLab's at 9. So if I had to put money on this, I would think that Monday.com is probably the best comp here. And I think that Figma will probably trade pretty early on at a discount to Monday, just based on the fact there's some unpredictability there, right? They haven't been public before, so people are going to want to see how they perform as a public company. So my guess is that they probably start trading pretty early on, somewhere around 12 times ARR. And if they go public when they're sitting at about $1 billion in ARR, which they would probably be pretty close to right now as of Q2, that means that they'll be trading initially at about $12 billion, right? Now, I think this valuation multiple probably holds. So depending on the timing of the IPO and their growth rate over the next few quarters, there might be some fluctuation here. But my guess is that Figma trades pretty early on, somewhere around 12 times ARR, right? Let me know if you've got a different prediction. Let me know how you get to the number. Be interested to hear your thoughts on that. All right, last thing I want to cover cover today is SaaS performance by category. So for the first time ever in the State of SaaS report, we did some kind of cohort analysis across the companies that we track. And so we broke them down and looked at them in 3 separate kind of categorizations, right? We looked at high growth SaaS companies versus low growth SaaS companies. We looked at PLG versus sales-led motion SaaS companies. And then we also broke them down into different categorizations. So we took the 35 companies that we track and we split them into 4 categories, right? Business apps, security apps, data apps, and then developer tools. And what I wanted to do here is to look at these different categories and to see how they stacked up in terms of some of the most popular SaaS metrics that we follow, right? The first one that we looked at was ARR growth rates, right? So how do ARR growth rates vary based on the category that the companies sit within? And what we can see here is that these data-focused companies are growing at a faster rate than anyone else, right? Their median growth rate in Q1 was 26%. At the other end of the spectrum, we've got the business apps with the median growth rate of 14%. Security came in at 22, the dev tools came in at 19, and the median across all of the companies that we track was at 18%. Right, so data companies winning the day here. As a reminder, the companies we've got in that category are Snowflake, Confluent, MongoDB, Pure Storage, and Palantir. Right, so these companies are growing almost 50% faster than the median company in our cohort. Right, now let's look at CAC payback rates. Again, data companies win the day here, right? 36-month median CAC payback period for them. Still not great, but much better than business apps, right? So business apps came in at 46-month CAC payback period. Security's at 41, dev tools at 44, and the median across the companies that we track at 38 months, right? Next, we looked at sales and marketing spend by category. And what we can see here is that the business apps are spending the least on sales and marketing as a percentage of revenue. Now, the driving force here is likely that we've got much more mature companies in this cohort, right? So we've got companies like Salesforce, ServiceNow, Workday, who are kind of past this hyper growth phase and are more into the phase of kind of generating operating income and free cash flow, and therefore spend on sales and marketing, or their attempts to kind of capture market share are smaller than they once were, right? So they spend the least on sales and marketing at 35%. And then everyone else is pretty flat across the board, right? We've got 42% for security, data, and dev tools, and then the median comes in at 40%, right? If you found that kind of like breakdown interesting, check out the Q1 State of SaaS report, right? We've got the PLG versus sales-led growth, and then the high growth versus the low growth companies in there as well. So if you want to see how those different cohorts stack up, go and grab a copy of the report. There'll be a link to it here in the show notes. That's it for this week. Thanks for tuning in. I'll see you here again next week. Until then, goodbye.